than your currency. Splurging millions, buying houses like Monopoly. Fucking 9 to 5, man, the money is a joke to me. Buying cryptocurrency, my money in the privacy. I make it rain dollars.
Hey guys and girls, welcome to this week's episode of the No-BS Birchy podcast. I'm your host, Nathan Birch, and this is a show unraveling the truth to the facade of the 21st century. We're now exiting the matrix and waking up to motherfucking reality. And that it is. This week here we're talking about my new rules for investing through the property cycle that we're currently in and how to build a recession-proof property portfolio and certain things that I've learned over the years that you could apply to the very relevant market in 2022. So going back when I first started the B.Invested group of companies back in about 2009, I was making some podcasts, not podcasts, so just like YouTube videos and stuff like that. Talked about three things. They were buying a property below market value, upside for capital growth, and strong cash flow. I feel like I've said it so many times over the years and I get bored by saying it, but it's important because new people come on board and they don't understand those things. So I've had those three things that are very, very important. But in the last 2 years or 3 years, since we started seeing massive inflation, there's two new things that we can look at. So we need to have 5 tips for buying a property in 2022 and moving forward, which are very, very crucial. And those two new ones are buying below rebuild cost because of inflation, and secondly, buying where servicing is strong because then there's upside for future growth because that's what's going to limit or allow for that growth. So I'm going to start on the 5 new investment strategies, rules for investing. And I want to talk about the other areas of scenarios and stuff like that. So I guess the first one is buying below market value, right? Buying below market value will last you throughout any year, any cycle that you're in, right? If the market is shit, and let's say you buy a property for 300 grand and everything else is selling for 400 grand, you're buying at 100 grand below market value or 25%. By doing so, what that means is that if the market was to fall 100 grand, and you had to get out, then you wouldn't blow your fingers off, right? Firstly, so if you're buying a property below market value through a recession and something goes wrong, the market wouldn't fall 20%, 10%, 15%, 30%, whatever. If you're buying it that cheap, then you've got a buffer that's built in from day one, so you're minimizing risk. Secondly, and most importantly, buying it below market value gives the opportunity to get in, buy it, revalue it quickly because you've got the value in it, pull out the equity and use that equity as a deposit for your next one. When should you do that, right? If you have 100 grand in equity, should you go and pull that out at the bank? Well, you've got to work out if you're pulling out 100 grand at 4% or whatever interest per annum, and you can go and invest that and get yourself a 7 or 8% interest per annum, then you're going to get a better cash-on-cash return on that money that you're investing. So you're making money on money that's not even yours. If you're going to earn $100,000, pay 30% tax on that or 40% tax on that. It might take you 3, 4, 5, 6 years to go and save that same amount of money. And in that period of time, you're not having that deposit. You can't go and buy more assets. And in that period of time, inflation hits and then it goes up in value and all that sort of stuff. So very, very important to understand how your equity works. That's something that I didn't understand for maybe about 5, 6, 7 years of my investing. I used to work hard, earn money, go and put down my deposit, buy the property, and never pulled out equity. And it was at a later point after I tried paying off properties, I was like, this is stupid. Then I went, this is how you get ahead. And I started looking at equity and I was working smarter, not harder. If I was to build my portfolio again, I wouldn't be working 2 full-time jobs. I'd just be using equity and being wiser about it. The upside for capital growth as being the second point, is the importance of buying a property that's got upside for capital growth is that you want to see the growth in the future. So that could help you buy, you buy a property for 200 grand, it goes up to 500 grand or $1 million. Then you can sell it off and you can take that cash and use it for whatever else you want in your life. But most importantly, if you had a debt reduction strategy, you buy 20 properties and they double, and you sell off 10, and then with the profit from those 10, you pay out the other 10. That's a debt reduction strategy. You wouldn't be able to do that if you didn't have the capital growth in the properties, which is ultimately why most people buy the properties. You want to have that. You want to buy a property that's got a strong cash flow. When I say strong cash flow, everyone thinks I mean positive cash flow, but I want it to be neutral, right? If the property's negative $20 a week, or if the property's positive $20 a week, it's fairly neutral, right? Interest rates can go up, expenses can go up, but at the same time, rents can go up, and these things are variable, so it's not locked in stone. But buying it where it's got a strong cash flow, if it's neutral cash flow today, after all expenses, council rates, water, real estate fees, strata fees, maintenance, whatever, then and you look forward in 5 years' time, if you can put the rent up $10 this year, $20 next year, you could be $100 a week positive cash flow over that period of time. So if you've got 10 properties, $100 a week, that's $1,000 a week positive cash flow. There's 50 grand a year. There's your lifestyle, base lifestyle sort of covered. So that's the importance of having the cash flow there, which I think should be important for most people to be buying properties for their cash flow. And then the two newest ones, which is point 4 and point 5, which is buying the property below rebuild cost. If you are buying the property and you are paying more than the build cost, well, then there's nothing too bad with that. But if you're buying it below rebuild cost, well, then you know that any other property that needs to be built in the market will have to come onto the market much higher than the cost that you're paying for the property today, which will automatically suck your property up as a lazy investor. I'm a lazy investor. I want the property to perform every task for me with minimal outlay. That's why I don't build property. That's why I'm not a developer. That's why I'm not doing certain things. Because I'm a lazy investor. I collect assets and I want to see the assets grow in value. I've never had anyone call me up and write a message in the comments saying, hey, Nathan, I'm so happy I sold a property 10, 20, 30 years ago. They're always like, I wish I bought more and I wish I didn't sell. So you want to be buying a property below the rebuild cost because then it protects you. It also sort of guarantees a couple of those other first steps that we're talking about by risk minimization and knowing that there's a pent-up demand. You can't afford to build the property again for that price that you paid for it. Well, that's where the intrinsic value starts to lay. Point number 5, you want to be buying in areas where surfacing is strong. A lot of people think, okay, I'm going to buy in this nice area. It's got up so high. The average house is $1 million, $1.5 million. Well, the average family can't afford to pay any more money for that at the moment. Something has to give. So how's it going to go up from $1.5 million to $3 million? Miraculously, right? The people can't afford it. The average wage in the area doesn't allow for that to occur. So if you can buy a property in a market where the average income is 80 grand and the average house is 250K, well, then you've got a lot more upside for those properties to go up in value. So it's going to support point number 1, number 2, number 3. So looking at those points, if you buy a property below market value, well, then in any market, you're going to be making money and you've got a buffer in place. If you buy the property where it's got upside for growth, well, then that's going to serve you for your long-term goals. If you buy the property where it's got a positive or strong cash flow attached to it, well, then that market, like if you lose your job, you don't have to worry about having to pay for that property without a job. And I think a lot of people will, they just buy properties because they think it's the right thing to do, or they think, it's good, but it's based on their position today. I always thought when building my portfolio, I got to 20, 25 properties before this point, and I was like, if I lost my job tomorrow and I had to work at Macca's and those things were to turn to shit for me, well, then at least they would be able to look after themselves. They've got their own heart, lungs, respiratory system to be able to support their own, stand on their own 2 feet. So those things are very, very important. Looking at scenarios and analysing deals before you buy them, I think it's important to sort of prognosticate and fit the property into scenarios. So I work from a lot of Excel spreadsheets. I've always drawn up different scenarios, equity, cash flow, risk, minimization, all that sort of stuff. 5 years' time, 10 years' time, how could this work out for me if it attributed certain results? I always want to work out sort of like what could happen in this scenario, what will most likely happen, what's the worst case scenario, how can I minimize risk along my journey. And when I buy properties, like it's given me big brass balls of steel to be able to go, cool, I'm going to make a call. And people sometimes think that I'm flippant because I'm just like, oh yeah, I'll buy that, I'll buy that, I'll buy that. And some people might even say to me, Nathan, that's you, that's not me, I've got this risk. I was able to develop that, right? You want to be able to develop that sort of skill set by able to analyze and understand how the deal's going to affect you and prognosticate into the future. A lot of people don't do that. They just go, oh, it's a good deal, or I better buy it because I've heard on a magazine or an internet forum that it's a good hotspot to go and buy into and all that sort of stuff. So you need to look from all different scenarios. And you want to look at how you can minimize your expenses, how you can add some sweat equity. When I first started investing in properties, I used to give them sweat equity, right? I was on 40 grand a year income. I was working a second job to be able to afford to buy more deposits and all that sort of stuff. It was too dumb and I didn't understand how equity worked. It took me like 6 years or 7 years to be able to understand how, maybe 5 to 6 years before I understood how equity worked. I thought, let's pay off the property. I was working hard to pay off the property, pay off the mortgage. And then I was like, I'll put that towards the next deposit. And I was like, what? I could get equity and I could go even faster. But it all comes with right timing and knowledge and confidence building. But I'd do sweat equity, so I'd go and pull apart. I actually went and pulled apart old houses, right? I'd find demo sales for someone's knocking over a house. I'd say, hey, here's $100, here's $500. Can I spend the night in your house pulling apart all stuff? And they're like, they're going to just take this shit away tomorrow. Yeah, sure, stay there. And I'd take out the big timber beams out of the rafters. I'd take off the new clip block, roofing on an extension of a place. I'd take off the sunroom with all the windows that are attached. I'd take out the carpet. I'd take out the vanity units. I'd take out all the kitchens. All these things added up as value that I would have to put into a reno. So I did used to do a lot of renos. Going back many years ago when I first started out my YouTube channel, my YouTube channel was based on renos. B.Invested started off looking like a tradies website before I started going into strategies, but unfortunately someone went and deleted my YouTube videos, which some of those videos aren't available online anymore. But looking at the cost of building, those things, I could add value greater than what it would cost for a tradie to do it. I would add intrinsic value to the property. I don't touch any tools nowadays. I try to structure my renos very carefully. I understand the cost of labour. I understand the cost of skill set. I know when someone's going to rip me off now today if they're telling me a quote. So I know how to value things because I've had to go in the trenches and do it myself. So that's something I learned back in the day. And I think it's important to have a solid foundation property portfolio. A lot of people want to go out there and they try and, build, I'll buy a house, I'll renovate it, I'll sell it, and I'll make some money, and I'll pay some taxes, and I'll pay some agent fees, and I'll pay all the lawyers' fees, and I'll be left for $50,000, and I can go to another one, and I'll make some more money. But what those people are doing is they're valuing a dollar or some money over the value of having an investment portfolio. Someone's trying to buy, reno, flip, and all that stuff. They don't understand the way that the monetary system works. They don't understand how debt works. They don't understand how the intrinsic value of building wealth works. They're just looking at a dollar, right? And that's why you never hear me talking about how I'm going to make a buck out of doing a flip and do this and do that. I'm all about building wealth because I respect the asset more than the money because I have no respect for money, especially when you can print it and manipulate it as cheap as they do it in today's market. But it's important to have a solid foundation portfolio. For me, I always thought what would go wrong if this happened, what would happen if this goes wrong. So I thought before I start messing around with bigger, trickier types of properties, I want to build a portfolio of like 10, 15 properties as shit hit the fan. If those things just I hold them for the next 10 years, 20 years, I'm going to be a very rich, wealthy person in the future. And as that worked on, I was like, hang on a second, now I can play around a bit more with buying some commercial properties, some renovation properties, some subdivision properties and stuff like that, and be able to, explore those opportunities and, just keep building the portfolio on top from there. So I've got land banking portfolios, I've got cash flow portfolios, I've got my foundation property portfolios, and I still buy properties that would fit into my foundation portfolio in 2022. So it's not all just, let's go and play a game of Monopoly. Macca's has a system and a process. They make a cheeseburger, they make a hamburger, they make a Big Mac. They use the same patty, different bun, same onion, different sauce. They mix it up. And they've got a pile of 10 different ingredients that they can make 20 different burgers out of. And that's just simply because they've got a process and a system. They cook them, they have how they go in. People come and get their drinks, they hand them out the window, all that sort of stuff. So how I look at building a portfolio is much like that process of building a cheeseburger. So I think it's important for you to treat your property investing like a business, have a business plan around a strategy, and be able to use that strategy to take you through any sort of market. So I don't sit here today and say, hey, I'm going to buy this type of property, next week it's a different type of property or some other sort of strategy. It's a strategy that works. It's nothing sexy, nothing flash, but it's very, very fundamental. And the same thing applies with Macca's, right? The process is very fundamental for you to be able to, get your food and walk away and whatever. It's very fundamental for them to be able to have a process and pump out large quantities of food. If I need to build a portfolio, I want to have the largest asset-based net worth position and see that continually grow in perpetuity. And I'm not risking that on, potentially a development might work, maybe a granny flat could work. I don't have any granny flats, right? Let me tell you, I've got over 200 residential properties. I don't have a granny flat on any of them. I have 30 plus pubs and motels and stuff like that. They don't have, granny flats on them. These are things that, you need to have a strategy that works well in your position. And with that position, it's important to work out, the foundation. For me, my foundation was buying all these little crappy properties in Mount Druitt, Western Sydney, Gold Coast, regional areas over the years. And then I've always sort of looked forward and like, what do I need? Do I need more cash flow? Do I need more land banking to hold? What do I need to add to my portfolio? And then I was like, okay, how do I get there? Most people sit there and go, I can't afford to have this. I can't do this. I can't do that. But they're not thinking. They're just looking at it from two-dimensional. I'm looking at it from multi-dimensional. It's how can I get this property to get me to that property? How can I make this work to get me there? My first motel that I ever bought was $1.665 million. People could not go and buy that thing cash, right? It had to be bought cash because there was no books, there was no money, no banks would lend on it. It's in the Blue Mountains. It's still like, I still own it. I'm doing a big reno on it at the moment. When I'm finished with it, from the business attached to the building, it could be worth anywhere around that $20 million value once I'm finished with it. But that property, people couldn't get into. How I was able to get into there is that I was able to use my foundation property portfolio. And, you know, if I had 10 properties in Mount Druitt, just a hypothetical example here, if I had 10 properties in Mount Druitt that I bought for $200,000 that went up to $400,000, if I could pull out 100, 150K, 50K, whatever it is that I could pull out from equity, I could use that money as a deposit to buy that property. I could use that money to go buy that thing cash. But a lot of people just think, okay, that's too big, I can't make it happen. And today, I work a lot from cash flow from my properties and from my motels and different parts of my portfolio that all help fit in the cogs to be able to push forward to the next position. And I'm at a point now where probably about $150,000 a week positive cash flow coming in from my assets. And I'm looking at, okay, in 5 years' time, I want to be at $1 million a month passive income coming from my assets. And it's like, how do I keep expanding that? With that sort of size, then I can start, you know, more aggressively growing and expanding, and the power of compounding fits in. So have a strategy. It all starts off with having a base strategy, having a base formula. That formula that I've talked about has worked through recessions, through booms. A lot of people throughout the cycles that we've seen of previous years are like, they get cocky. They get, oh, I'm so excited. I can do this. I can do that. I can make money this way. I can make money that way. They lose sight of it. And I've seen a lot of people that have bought large portfolios and sell them because they're not focusing on their portfolio and they're trying all these different strategies and end up and it's like, okay, that strategy doesn't work now. Now I've got no assets. Now I can't rebuild my portfolio. It becomes a different sort of scenario. So it's very important to understand your goals, stay committed to your goals, stay focused on your goals and keep working towards your goals, and then be able to work out, does this get me closer to that or does it take me further away, and what is the risk that's added into it? If you need help on formulating a plan, on help on, you know, getting a strategy in place, or you feel like you're stuck at some point, you can reach out to my office, 1300-367-925, speak to one of my investor relation managers, send us an email, admin@binvested.com.au, or just as you're doing now, just keep learning, keep filling your mind full of knowledge, make decisions based on the knowledge you get, make sure that you have clarity on it. Numbers don't lie, your emotions can lie, people can lie, certain things can lie, but your numbers won't lie. So just focus on the numbers, focus on your strategy. If it works for you to get to where you want to be, reverse engineer where it is that you want to be, and just take steps that are in line with that. Make sure to subscribe. Check us out at Google, Spotify, Apple Play, YouTube, and give us a review, give us a like, and share it with your friends and family if you've got comment, if you've got good content for the day. We'll catch up soon. Have a great week. Bye for now.
Like Bilal said, man, we're stuck in the matrix. This my advice, don't care if you take it. The dollar about to die, soon to be hyperinflated. This my 2 cents, don't care if you save it. Joint be decentralized and you will see you've been lied to the whole time, and it's the irony, cause they do the exact opposite. You become a slave to the system, enough your money, all they do is profit. There's no conspiracy theory, you better hear me. Crypto will set you free before the system does. I don't care if you do or you don't, but what I'm saying is the truth to the reason you choke. I've never been a failure, excuse my behavior. Keep talking, haters doing me a favor. They all telling lies, I know what they been telling you. I'm the opposite, the Donald Trump of Australia. It's amazing, here for the taking. My time is never wasted, just getting wasted. These girls say I'm really breathtaking.